Welcome back to the floor of the CME Group here in Chicago. Fed Day, Wednesday, June 22nd. I'm Killer from Treasury Curve. Got cash? I can help. We have a great institutional money fund portal to assist you in that overnight cash management. Get me at The Killer, or comment here in this video. We can be in touch. Let's look. We have Ben Bernanke and team. Uncle Ben. A lot of people looking at the language today. This language, very specifically, they want to see if it's altered at all. Obviously, the extended period of keeping these rates down, they're going to look for that. Will there be a precursor in front of that extended period? Will there be a really long, we're kind of trying to figure that out. And obviously he alluded to this last time that they're going to hold those assets. That brings me to the point I want to talk about today. The Fed's balance sheet. $2.811 trillion. It's a lot. We've seen this expansion of this balance sheet prior to 2008. We're actually about a full $1 trillion north of where it was prior to 2008. The debt ceiling issue, maybe that balance sheet expands. And you break that down, they have about $1 billion in MBS. They have about $1 billion in agency debt, and they currently are owning north of $1.5 trillion of treasuries. And that, being a bond trader, that is what we're looking at here. We're looking for that language, say some type of lead-in about when are these rates going to happen. And as a bond trader, we look at those holdings, at $1.5 trillion worth of holdings. When those start to drain, that is when they're going to be allowed to move rates. So I think, folks, we're stuck on zero for quite some time here, but we're looking for some clarity from Ben today. We've talked about QE3, and they've actually said there isn't going to be a QE3. But let's think 1 second here. Every time we have a conversation when we have a down week in the market, you can feel that the Fed is poised. They're poised in their decision, and they're going to be reactionary. So we're going to continue to see this reactionary. In the event the market, this soft patch, gets a little bit deeper, a little bit darker, they're going to come and do something. So I think that underscores the market. We've seen a nice little bounce in the equities here. We just came up to this 1292 level here in the S&P prior to Ben talking. So I think the market is kind of saying, in the event we do come off, and in the event we are in the soft patch, we're going to have some form of stimulus, some form of support from the Fed. So why are we going to get out of our S&Ps? It's a safe haven. So let me know what your thoughts are. Are the S&Ps a safe haven here? We're clearly seeing gold getting grabbed, and we're obviously seeing the treasuries, that bid persists, especially in the belly today. We've really seen the belly bid of, obviously the curve flattened out last April. They started buying, the 10-year note and brought that 10-year rate from 3.75 all the way down to under 3%, where it is currently quite comfortable. So as we saw that flatten, now we're seeing a little bit of the short-term rate, and that's the predicament I think the Fed is wrestling with. Obviously, we need short-term rates to be raised for growth, but how can they raise those rates if we're in the environment where possibly this recovery gets derailed? So it's quite a complex situation for Ben. I don't feel like he has the arsenal like he did prior to 2008. So I think he's got the prevent defense out right now, and he's going to be reactionary, but he's going to kind of convey that to the market today. So be aware of that. Euro currencies we're seeing back above 144. I think that's kind of in relation to the U.S. dollar continuing to get beat up a little bit, currently residing under 75. Crude oil, I've been tweeting about this 94.83. It's a great pivot. We saw some inventory information come out this morning. It went through Monday, that 95.10 high, broke through there, made a marginal new high at 95.40, and came off, rotated underneath that killer pivot, and went back down. So keep an eye on oil. Oil is kind of in no man's land. Typically, it's been correlated with the S&P as well as the Dow Jones index, but it's kind of broken out. It's kind of playing its own game right now. In the 30-year, obviously we're going to see that 125.12 pivot kind of came down there, tested that, but they bid them back up. They continue to grab the treasuries. The S&P, I think we have a pertinent band right here from 1268.50, which is the weekly pivot, up to the 1299 resistance area. And the 1308.25 is coming in the 100-day. So play this. But folks, I think you have to be alarmed a little bit because the 200-day moving average down at 1251.50, that did not get violated. So I think there's going to be a back and fill situation. Clearly not today, but obviously in the next week or two. So that signals to me that the bottom is not in. Be careful today. We're going to have a lot of information thrown at us. It could be a pop and a drop, could be a sell-off and a buy. But be nimble, because days like this, when this information comes out, people interpret it differently, so it can really make a volatile environment. Good luck today from the floor of the SeaMaker. I'm the Killer, and remember, very important today, one thing to do, be the hammer, not the nail.
On the road, gotta be strong, move on and rebuild our own. But before you go,